LiteFinance, the world of financial freedom.
Hello, it's Monday, September 25th, and it is time to start the market forecast for this week. Nothing changes, so as usual, let's begin with the calendar. So on Monday, as usual, nothing is happening. On Tuesday, we will get Bank of Japan core CPI and CB consumer confidence from the US. On Wednesday, durable goods orders from the US and crude oil inventories, which will be very interesting to see how stockpiles are continuing to react after recent decisions from OPEC and Russia. On Thursday, we will get the final US GDP reading, and in the evening, Fed Powell will answer the questions from the public at a teacher town hall meeting. So, it is nothing major, but as always, it is better to at least have it running in the background. The best comes on a Friday with the Tokyo CPI data, UK GDP final figures, and most importantly, Eurozone CPI and US PCE inflation data. Okay, now let's move on and discuss fundamentals and prepare some trading plan for Euro USD. So, everything has turned upside down in the financial markets. The peak rates are no longer breathtaking. Their increase does not lead to the strengthening of currencies. Investors are only concerned about one question: how long will the borrowing cost stay on a plateau? The longer the better for the euro. Therefore, it is not surprising that it was not the hawks, but the ECB centrists who saved the euro. Their neutral stance was one of the factors that allowed Euro USD to stabilize. Instead of raising the interest rate following the Frankfurt example, London made a hawkish pause, thus helping the declining pound. The words of the head of the Bank of Greece, Yanis Stournaras, that the ECB will soon reduce the borrowing cost, and the statement of his colleague from Croatia, Boris Vujicic, that the September act of monetary restrictions was the last, helped the Euro USD bulls. As well as a speech by the head of a Bank of the Netherlands, Klaas Knot, who does not expect changes in monetary policy, at least in the near future. The markets watched as the rates reached unprecedented highs. However, regardless of the effect, you need to go further. The decline is far away, so all that remains is to stay on the plateau and watch how neutral rhetoric leads to a raise in German bond yields to the highest level since 2011. It rarely helps the Euro-USD bulls. Of course, the US dollar has something to answer. Rates on 10-year treasuries have soared to the highest since 2007, on 2-year ones to the maximum since 2006. The daily increase in the yield of 30-year bonds showed the best performance since June 2022. Debt obligations are being sold off as the federal funds rate is expected to remain at a high level for a very long time. The problem is that it is not enough for the Euro-USD bears. Many factors have already been priced in the quotes of the main currency pair, and the longest series of weekly losses hints at a correction. The market has realized that there will always be high rates. So this is signaled by the updated FOMC forecasts for a neutral rate, which does not stimulate or cool the economy. Already 5 out of 18 officials have raised it from 2.5 to 3%, not 3 as in June and not 2 as in December 22. Jerome Powell once noted that one of the reasons for the striking stability of the US economy is the growth of the neutral rate. In the new reality, the yield of treasuries seems too low and the positions of stock indices are too high. An increase in debt rates and a fall in the stock market will support the Euro-USD bears in the medium term. However, anything is possible in the short term, including buying the euro on the breakout of the resistance at 1067. So why don't we try to take advantage of the factor of mass exiting of speculative shorts? Let me know what you think in the comments below. For now, thank you for watching and I'll see you next week. Goodbye.